All eyes now are on the Fed. We recently had a comment from one of our viewers about an old video we made quite a long time ago talking about the Fed's dual mandate. And we thought now more than ever, it's important that we revisit this subject. What is a dual mandate? What is the Fed exactly waiting for? And does this mean a bear market's coming? We're going to talk about all these things. First off, what is a dual mandate? Congress has assigned the Fed to conduct the nation's monetary policy to support the goals of maximum employment and stable prices. Those two goals are often referred to as the Fed's dual mandates. In terms of maximum employment, it's the highest level of employment or the lowest level of unemployment that the economy can sustain while maintaining stable inflation, meaning that if we have too much employment, inflation starts to rise. Speaking of which, the Fed, the Federal Open Market Committee, judges that the inflation rate of 2% is most consistent with their mandate. So they want the best employment with inflation around 2%. Well, let's take a look back in time to see what were the triggers that caused the Fed to cut interest rates. First off, 2001. In red, that's the Fed funds, that's interest rates. In white, these are non-farm payrolls. Specifically, we can see in the middle around 2000, we had really good non-farm payrolls, around 484,000. That was followed by 168,000, followed by 126. And then finally, we see here that led to a cut in interest rates. Notice the red line going down. That's the Federal Reserve cutting interest rates in 2001. Notice how the non-farm payroll declined during that time. Let's look at what the data showed us. In particular, we can see February of '01, that was the first interest rate cut going from 6.5 to 5.5%. Well, what did inflation look like around that time? Around 3% on average. Now we see non-farm payroll during that same period of time, starting early 2000, we were in the 300s to 200s, even as high as 484,000 jobs created in March of 2000. But that declined. By early '01, we were actually in negative territory. So we see here, according to the dual mandate, now the 2% inflation target, just to be accurate, did not exist in its present form back in 2000, but the 2 to 3% areas where the Fed wants to see inflation. Nevertheless, we can see with inflation steady in the mid 3% area, all of a sudden in the year 2000, early '01, the jobs market really fell apart. That's the trigger that we were looking for in '01. That caused the Federal Reserve to cut interest rates. Well, how about in 2008? What was the trigger then? Well, again, in white, non-farm payrolls. In red, Fed funds. And we can see here in mid '07, we had non-farm payrolls reported around 226,000. Notice the red line across the top, stable. The Fed was not cutting interest rates. Then we had a pretty poor report. Only 79,000 jobs were created. After that, negative 25,000. We lost jobs. At that point, the Federal Reserve starts cutting interest rates. See, it's the same type of pattern. With inflation more or less stable, in this case, the Federal Reserve first cut interest rates in October of '07 from 525 to 475. During that period of time, we saw a rather stable inflation rate around 2%. During the same period of time, we went from non-farm payroll 226,000 in March of '07 going into negative territory. You see, it was the deterioration in the jobs market that caused the Fed to cut rates. The Fed raises rates to stem inflation, but those higher rates eventually eat away at the jobs market. And this is the trigger the Fed's looking for. But notice this is something very curious. And this is something I think the Fed wants to avoid this time around. After the Fed cut rates in October of '07 from 525 to 475, inflation took off. You see, that's the risk. If they cut too early, inflation could be back on the rise. And that's what they want to avoid, is sending cross messages to the markets. Now, we can take a look at 2019. This was the closest thing in recent history we've seen to a soft landing. Now, in blue, that's non-farm payroll. In red, consumer price index, our rate of inflation. The white area chart in the background, that's interest rates. Notice in particular, during this period of time, early 2019, and again, this is about a year before the COVID crisis. We didn't know anything about that at this time. The stable job market was matched with low inflation. So why did the Fed cut interest rates? The Fed first cut interest rates down to 2.25% in August of 19. Why did it do so? We can see the jobs market more or less was stable. It was, fluctuating, but it wasn't in negative territory. And we did have several months in the 2 to 300,000 area. But notice the inflation. It was below 2%. Interest rates were so high, the inflation rate came down to a point where the Fed says, we better start to cut rates, bring prices back up. I think they were afraid, especially with that jobs report in July of 19, only 90,000 jobs are created. That's too low. They want to see in the 2 to 300 area. Between that jobs market, that jobs report, 90,000, and the inflation rate below 2%, the Fed deemed it was ready to cut rates, which in fact it did. Now, fast forward to present date. Where are we now? With the CPI now for the first time in quite a while below 3%, we're at 2.9%. We see non-farm payroll, 114,000 new jobs are created. So putting this in perspective, is the inflation rate near 2%? It's approaching it. Is the jobs market deteriorating? And we know from history, a declining jobs market, we start to see numbers under 100,000. It'll be very curious to see if the jobs market falls below the next non-farm payroll falls below the 114,000. Now, of course, the Fed funds futures are predicting in the next interest rate meeting in September that they will cut interest rates. I think they're expecting that CPI to continue into the twos, maybe into the mid twos. And for the non-farm payroll number, well, I think they're afraid it's going to fall below 100,000. When will stocks decline? Because we know from history, every time, at least over the past couple decades, that the Federal Reserve has started to cut interest rates, that usually is associated with a decline in the stock market. Well, for that answer, we have to go to the bond market. In red, that's S&P 500. In green, that's the 1-year U.S. Treasury. In blue, 10-year U.S. Treasury. And this is the signal we're looking for, and it's been actually very reliable several times. We're looking for a crossover that will end the inverted bond market. The inverted bond market is when the short-term maturity bond, like the 1-year, the green line, is above the 10-year, the longer-term maturity. We see that took place in 2001. Notice the green line cross back below the blue line. That was the end of the inverted bond market. Notice the behavior of the red line below, the S&P 500. Stocks really began to decline once that inverted bond market ended. Fast forward to 2008. It's the same pattern. Stocks were pretty much at their highs, '07, early '08. But the green line, the 1-year Treasury, crossed back below the 10-year U.S. Treasury, and that signaled really a reversal in the stock market. Now, the stock market didn't collapse the next day. It took some time. But when the 1-year Treasury goes down, the 1-year Treasury, which, by the way, is more closely linked with interest rates, the shortest term bond out there, it's the anticipation that over the short term, in the near term future, we're going to see lower interest rates faster. And that's really the signal that the bond market's telling us. Well, where do we stand right now? 2024, we still have an inverted bond market. The green line, 1-year Treasury, is still above the blue. It's contracting. The gap between the two is narrowing, but it hasn't crossed over yet. But for a long time, and we will continue to watch the relationship between the 1-year and the 10-year. So as for the time being, stocks, Dow at new all-time highs, other indices not that far away. We certainly have a strong market, at least for the time being. Now, with that said, we asked ourselves the question the other day, why does it feel like it's a recession? There was a recent poll that asked people, why, do you think there's a recession? And 59% of the people polled said yes. Well, we know the classic definition of a recession is 2 consecutive quarters of negative GDP. We don't have a recession. So why does it feel like we have a recession? Well, we took a very close look at the data, In our Substack article, and provide you a link, it's absolutely free to read here. We analyze the different economic barometers, trying to determine which one is able to convey why we feel like we're in the middle of a recession, even though we have positive GDP. And so far, we know the non farm payroll number is not really in a lot of trouble, and that inflation is more or less stable and declining. We took a look at those numbers, and I think you're going to find what we discovered here to be quite interesting.